Welcome back, everybody, to the Venture Capital and Syndication in Los Angeles panel. I would like to introduce Dr. Deborah Palestrant, head of 459 Ventures, who will be the moderator of this panel. Take it away, Deb.
Hi, thanks, Mark. I'm Deb Palestrant. Thank you so much for joining this panel. As Mark mentioned, I'm a partner at 5AM Ventures, and I head up 459 Initiative, which is the de novo company creation arm at 5AM. I grew up in LA. I'm a UCLA Bruin class of 95, and so I'm a big fan of the LA biotech ecosystem. As you guys appreciate, the LA scene is really exploding. There are a lot of universities and institutions driving forward some really exciting, great new research. And I've learned that the audience, you guys are all entrepreneurs and academics or faculty who are exploring moving their technology out to a new co. So we have a great group of panelists, all of who do investing and building across the LA ecosystem. And I'm hopeful that this will be a great opportunity for you to get a taste of VC's building in LA. My firm, 5AM, is a bi-coastal firm. I actually sit in the Boston office. So I, like all of you, will be paying particular attention to what it takes to take an idea from academia and build it into a new co in the LA ecosystem. So I'm looking today to do about 35 minutes of discussion. So please feel free to enter questions in the chat, and I'm hoping we'll be able to get to all of those at the end. Mark has kindly volunteered to help me assemble those. And we have a great group of panelists here to share their wisdom. So to start, I'm going to ask each of the panelists to give a short introduction, basically your name, affiliation, a brief description of your fund, and then we'll get into a little more depth of how you guys work on company creation. I will employ the wonderful game of Zoom tag, so I'll call on one of you, and then I'll have you call out the next person to follow with the introduction. So Sean, let me start with you because you're first on my screen.
Great, thanks, Deb. And I'm a managing director and co-founder of Westlake BioPartners, and we are primarily involved in doing leading seed and Series A investments through company incubation creation model. And it looked like Helen Kim, you were the next on my screen.
Thanks, Sean. Good to see you again. I'm Helen Kim. I'm Senior Managing Director of Vida Ventures. Vida is also bi-coastal. We have an office in Boston, and we have an office, it used to be in Santa Monica, but now we are in Century City. And we, unlike Westlake Village BioPartners, we do invest across the spectrum and geography. So we invest in companies that are based on ideas, helping to build a company, all the way to investing in IPOs. And we also have some leeway in terms of participating in PIPEs and public companies. And we have invested mostly in the US, but we have investment companies in EU as well as in China. So I'm going to tag Nina.
Thanks, Helen, and great to be here. And Deborah, thanks for running show today. So I'm a NorCal interloper. I'm with Canaan Partners, and we are a bi-coastal venture firm with offices in Westport, Connecticut, Manhattan, and San Francisco and Menlo Park. But during the pandemic, I seeded a spin out of UCLA, and Helen and I are co-investors in a company with technology from Caltech and UCLA. So I feel like I'm a groupie to the Los Angeles region by virtue of that. Canaan's been around for 33 years. We were the original venture creation effort out of GE, or the General Electric company, but we've been independent as a venture firm for 3 decades now, always investing both in tech and healthcare. And for the last 5 or 6 funds at the very earliest stages, we typically do seed and Series A. And we were very fortunate last year to close our 12th fund, which is an $800 million vehicle to do new company formation and early stage investing. We stay pretty true to that thesis, although with every rule there's an exception. So we've done a couple of later stage investments as well. Look forward to talking more about strategy and glad to be here. And I will ask Kevin.
Thank you, Nina. My name is Kevin Barrett, and I'm a partner at Freeflow Ventures, which is a relatively new firm, given the vintages that Nina and others have talked about. So we're investing out of our first fund, and we invest at the pre-seed and seed stage, and then we do follow-on investments into the A round. And we're a little bit unusual in that our focus is exclusively technology startups at Caltech and the Jet Propulsion Lab, which is actually an operating division of Caltech. We're not bicoastal, we're based in Pasadena, and to date, our offices essentially have been at the Red Door Cafe on campus at Caltech. We focus on what Caltech and JPL do, which can be categorized as human health, which typically translates into biotech and planetary health. And we are involved in new company formation as well. So I'm not sure, I think Yinghong, you're next.
Thank you, Kevin, and thanks, Deborah. Glad to be here. So my name is Yinghong Gao, and I am a venture partner of Viva BioInnovator. So we are quite global, and I'm based in San Diego. We have a portfolio of about 70 companies worldwide. We invest in early drug discovery companies, typically at the seed to A round stage. We usually don't take a leading role in company creation, but we have enjoyed syndicating with quite a lot of the company creators. And we'll be happy to discuss further on the strategies next.
Wonderful. I think this is an awesome group of people to the question is really, you guys all alluded to the strategy a bit differently. And so I'd love to just go around and hear a little bit about what's the secret sauce that your firm uses, what's unique, what are some of the activities that you really work with the entrepreneurs or academics to really drive forward when you partner early with these academics to create new companies. So let me start with Helen.
Trying to unmute. So, I think some of my colleagues on this panel would share similar kind of approaches. And it really depends on the partnership and the experiences that the partnership has. And so for Vida, we have worked on a few company creations with closing of our third fund, which is, we already did our second close and will be imminent. We will be looking to do more company builds with entrepreneurs. I think where we kind of could bring to entrepreneurs is that our partnership has really kind of a great mix of partners with different operating experiences, deep biotech operating experiences, like what Sean Harper has from Amgen. So, for example, we provide operational support for our investment companies. If they're in early stages, it would include working closely with the company and the management or the entrepreneur in developing strategic plans, helping to secure facilities, recruiting talent, and also driving subsequent financing. So, for example, one of our portfolio companies that we helped to start is a company called Neogene. They're focused on personalized neoantigen TCRs. And with that company, with our investment and my role when I was on the board was to secure, well, actually first to kind of build out a US strategy. The company started in Amsterdam by scientists out of the Netherlands Cancer Institute. And we felt strongly that the company should at least be incorporated in the US. And so we have a research hub in Amsterdam where the founders are. However, we started building the US presence in Santa Monica. So I worked closely with Kite in trying to secure some of their facilities they no longer needed for CMC and also for research. We also helped to recruit from local talent, head of translational, head of CMC, VP of clinical development. And then most recently, we helped to bring on a chief operating officer from BMS. And because of the technology platform, we were able to get a very senior seasoned executive from Bristol Myers Squibb to move to Santa Monica. And so we're, all aspects of the company build and the presence, we can offer that. For some of the later stage investments, companies where we led either Series B or Series C round of financing, we're able to provide significant operational support, as in clinical development and business development. So for example, Vida led the Series C financing for a company called Pac Pharma. Pac Pharma, one of the founders is Tony Ribas, and my colleague here, Nina from Canaan, led the Series B investment. And because of Nina and our network and because of our relationship with Tony, we were super interested in investing in the company. But the company was in clinical development stage, and where we could add value is our experiences in cell therapy with Kite. So one of my partners, Raju Jain, who was head of clinical development at Kite post Gilead's acquisition of Kite, he spends considerable amount of time with a clinical group at Pac Pharma, providing his experiences, who the investigators should be, how to recruit appropriate patients, etc. For another portfolio company, Peloton Therapeutics, I was on the board of that company, and my background has been mostly in business development and M&A transactions. And I was on the board of Peloton Therapeutics, and I was able to really partner with the management and actually negotiating the M&A transaction with Merck that led to sale of that company for $2.2 billion. So I think from Vida's perspective, because we have many operators of biotech companies, along with great investment professionals, we can provide that kind of higher touch to entrepreneurs and early startup companies.
Yeah, I would say, Deborah, I think that's such a unique leverage, and it's really what gives you asymmetry as a startup, whether you're an academic or whether the assets are spinning out of pharma or sort of incubating as in-house ideas. That accelerant from that operating network, from that expertise, that operating wisdom, capital has become so ubiquitous in our industry, which is such a lucky thing. And for those of us that have been in this space now for 20, 25 years or more, it's sort of funny to say that money has become the commodity, because we've remembered the cycles of inability to raise, and when we were the ugly little stepchild and everything was about tech or 505b2 for a while. But now capital is so abundant and less differentiated. And what's really unique is when you have that depth of expertise. And since we're really thinking also about a geography like the Los Angeles region, for me, that is why partnering with a Westlake or a Vida or with a Viva or Kevin's fund is really special, because I have a lot of it, and Canaan has a lot of expertise and networks, but less so in certain specific geographies. And it's what gives you that extra leverage if you want to build the best of breed company in the Thousand Oaks area or in Los Angeles, Santa Monica area, and help recruit those executives. And that you're going to have the strength of support that locally. It's really pretty special to do that with firms that are right there in the backyard. Just as we can say that when we're company building, for example, Canaan has done a lot of company formation with Yale in New Haven, which is also a less frequented geography. And because we are there and have been able to really work hand in glove with some of those academic founders, we've had a really unique accelerant to company formation there. I can't really add to the things that we bring to bear, but I would maybe say that, it's not infinitely scalable. We're all very thoughtful about how many of these new company formations we do in any given fund or in any given year. And the model that we like to think about is that we do it as a bartering system. We will start 1 or 2 or 3 of these a year as a group of us at Canaan. We're 6 check writers, and we hope that 5 a.m. and Westlake and Vida and others in the ecosystem will do the same, and we create these preferred co-investment dynamics, because it takes a village to raise these babies.
I'd love to ask Yinghong to comment, because I know you guys have a unique way of partnering as well with academics.
Yes, so we actually work with a lot of academic funders. So something about us is the company was built upon a wealth of knowledge in early stage drug discovery. So we're part of the Viva biotech, which was founded by a structural biologist. And so we provided this early stage drug discovery service platform for many years, serving global drug discovery companies worldwide. And because of that in-depth knowledge, that given us the desire to invest in the same area. So that's why we only invest in early stage therapeutic companies. And that works out well. So we obviously, as an early investor, we emphasize on solid science and an experienced team. And we're truly agnostic to drug modalities or therapeutic areas or geographic region. But giving that service platform that is right there available at our fingertip, we are willing to invest in early technologies that was not fully validated or doesn't have the proof of concept data. For example, Viva has a world-leading platform for structural biology or biophysics. And these are all very valuable tools for the drug discovery in the early stage. So that's why our investment comes in 2 forms. It's either cash or cash in combination of in-kind service. And with that, we can sometimes the company, a lot of academic funders may be working on very brand new targets. And for example, one of the company that we invested in was with a scientific funder from UCSD with a brand new target, and we could use our unique screening platform. It's called Affinity Selection Mass Spec to identify early leads, and then with secondary assays, validation, and then eventually deliver a co-crystal structure. So that kind of activity is very valuable for early stage drug discovery. And then some of the capabilities for de-risking, and another company with also UCSD and UCSF professors, that one, we closed the deal right before the pandemic hit the US. And the professors were having hard time to set up a lab somewhere. And that was a cash in combination of service as well. So we put down a few FTEs behind the chemistry and biology effort. And with that kind of setup, the company was able to drive the discovery program forward and with almost the same speed because the scientific founder was also a founder for another company that got sold to Roche. It's called JCure. And he told me the speed was almost the same comparing the previous company. So so that is one of the unique business model that we have that allow us to do early investment. But obviously we understand the risk of it because it being early has a lot of risk. And that's why we build a lot of companies. We invest in a lot of companies. So our investment only started about 4 years ago, and we already built up a portfolio of about 70 companies. And I would say many of them are actually based in LA, like Southern California area or California. And because of that, we can also kind of like foster a community with a lot of founders, network, and help each other and share know-hows. We organize annual partnership event with educational seminars, with pitch. So our last partnering event was in March. We have like 25 companies pitching to like 200 something investors. So it's a lot of fun to be able to be so involved and so intimately engaged with the companies and see them grow.
That's awesome, guys. I'm going to skip to the next question unless others really want to jump in, but I know I have a whole bunch more questions that I'd love to get to. So Kevin, do you want to say anything?
I'll just quickly add, to the extent that this is different, we tend to get involved with faculty members at Caltech and engineers and scientists and researchers at JPL before they've even realized or decided that they want to start a new company. So they may have something that has translational potential and they sort of have a sense, but they're not really sure what to do or how to get there. So we form those relationships very early, which, in simple terms, in the interest of time, assures us a position as either the lead investor or at least a member of the syndicate when the first investment event happens. So that's been very effective, and we've now made 8 investments in roughly a little less than a year, which is when we first started investing about this time last year.
Kevin, actually, that was a perfect tee up for my next question. So you may just want to keep talking. Okay. I heard from Yinghong and Nina, it's not an infinitely scalable process because we only get a handful of these opportunities to really roll up our sleeves and build each year. Yinghong, there's a lot of early amazing science out there, and Kevin, you partner very early. What is the best time for an academic or an entrepreneur to approach a VC or your firm, and what should they come with? What sort of data? When is early too early? When is sort of that sweet spot for them to say, yeah, this is the right time, and you guys really getting excited about digging in on something?
So you want me to just run with that for a minute?
Yeah.
Again, given our early entry point, we would say early and often, come to us if we don't get to you first. And our hope is we actually find them before they find us. But regardless, I think the thing that they need to bring, particularly for an academic startup, if the faculty member is going to retain their faculty role, which typically happens, so they want to keep their tenured position. And so they'll serve typically as an advisor, a board member, a consultant. But if you really are serious about starting a company, then you need to identify, if not the team, at least the person who is going to be 100% dedicated to that idea and to that effort. So when we put our money in, we need to have the answer to that question. And we often work with future academic entrepreneurs to figure that out. And some of them, somewhat naively think that they can do it, weekends and evenings and with maybe 20% of their normal working time. And that, at least for us, doesn't work. So we would encourage people to come to us because of the stage of investment. We don't expect a lot in terms of historical financials and a lot of information. The science needs to be proven. Once the science is solid, then you have our attention.
Awesome. Sean, do you want to weigh in on that one as well?
Yeah, I mean, I think the answer to this will differ on the model of the venture group.
Right.
So I think things for the entrepreneurs in the audience to understand is you have to kind of do some homework and understand who you're approaching. Because, for example, for us, we're all, myself, my partner Beth Seidenberg, our principal Desmond, we're all experts out of the biopharma industry and drug discovery and development. And we tend to focus on projects that are at most 3 years, sometimes a little more than that from IND. And so, we're human therapeutics focused. That's all we do. We're not going to play in medical devices or diagnostics or digital health or any of those things, just because we want to play to our expertise. And so we will, look for situations where, let's say there is a platform technology, but there's also some kind of ideas and lead molecules and things that are coming out of the platform that could be translated into human therapeutics. And so you certainly don't have to have a clinical candidate. That can be something that you work toward in the first, 18 months. And then, we're generally looking for situations where we see great science, the translatability. It like we've heard from many of the other panelists, the situation can be very varied. We don't expect our academic founders to leave their faculty positions typically, and we don't even really encourage that generally, because we do want to build a professional management team in these companies with the CEOs. We often bring, MD, PhD type phenotype people into the CEO roles, although sometimes they have other backgrounds. And we help to build out the scientific team. And we put in a tremendous amount of energy into just how to develop the product candidates and what kind of clinical development. And so our sweet spot is this period pre-IND to some kind of early human proof of concept readout. And all of us, I think, have found that to be the most interesting, even though I've practiced across the whole spectrum from discovery to supporting products that have been on the market forever. It's the most interesting area intellectually, is this area from sort of lead optimization through human proof of concept, let's say. And it turns out that, of course, that matches up with a very steep part of the value creation curve in human therapeutics venture land. So that's our sweet spot, and that's what we do. So when people bring us things that are, very much earlier than that, and that, it's going to be like 5 to 7 years before IND, we love to hear about the science, but we're just less likely to do that than, for example, some of our other panelists.
I think what Sean is, touching on is that I think most institutions, academic institutions these days that have technology transfer and that have a translational orientation where science might turn into business, have some sort of a venture mentor program at the institution. Or they have some sort of coursework, or maybe there's a business school, or there's some entrepreneurship program at the undergraduate level. So take advantage of those to get some coaching and some feedback, and take advantage of your own personal network, as well as what is just available on the internet, to understand who you're approaching and what they invest in, and also to understand what are the norms for technology like yours to be translating into funding, whether it's seed funding or venture capital funding, so that you are approaching and spending your time wisely, matching where you are to who you're approaching for funding. Nothing is more of a turnoff to an investor than to have someone approach you when it's completely off the mark, because it's suggested that you haven't taken the initiative of the time to do the bare minimum of very easy homework to make that match. And there's so much information available. And there are also so many business school students and undergraduate entrepreneurial students who would love to do projects with really smart scientists, entrepreneurs, to say, let me help you understand what is the competitive landscape, what are the historical failures and successes in your space, what do budgets and timelines look like for a project such as yours, so we can put together a pitch that makes sense to the right kind of investor for you. So I think that's an important sort of mapping to do before you make your first outreach. And then the last thing I would say is use your own personal network or friends of friends and make your first couple of conversations informational and not pitching, and use them to really get a tour guide's view of the VC landscape before you go out and make your first meeting, so that your first meetings really are as fruitful as they possibly can be.
So I just wanted to add to that I, there are many different models of venture investing as described by this panel. But I do think that when entrepreneurs or, PIs with company ideas approach venture firms for funding or whoever, I do think it's really important to at least be very specific about the value proposition, which should include like IP and some data of validation that could be reproduced. And, so appreciate Sean's comments about it really depends on the venture firm's kind of investment thesis as to how early do you invest. We all know, even 5 a.m., Third Rock, TCG firm I was with in the past, they would invest in just very early, science, just based on the biologic insight. And those funds have kind of a longer investment lead time and have the patience over time versus, other funds, they may have a shorter investment time. And so that's really important to understand. So at least for Vida, we like innovation, breakthrough, but we do look for, validation data. And it does help to have some in vivo efficacy and safety data and relevant disease models early on. But of course, it's all great if you could understand, if the mechanism action is somewhat elucidated. And then, IP is really important.
Great. Thank you, Helen. We are flying through time much quicker than I had anticipated. So I'm going to skip a question and I'm going to go to an LA-focused question. I know in a pre-call, we had a nice active dialogue around talent and geography and how that makes a difference, in particular in the LA ecosystem. So I'd love to start with Nina and get Kevin's feedback as well around the talent geography question and how maybe it's changed over the last 14 months with COVID, and how you think about that going forward to both retain and attract talent, or attract and retain talent to the LA area. So Nina, I'll start with you.
Well, as someone who's really not building as much in LA, but rather elsewhere, I'm not sure I'm the best person to speak to what the dynamics are in Los Angeles. But I do find that, recruiting and retaining talent is more challenging today than it has been in my 25 years in this industry. And at this moment in particular, right this minute. And I would say it's two factors. One, it's a hot market. It's incredibly competitive. And so people are being wooed from within our companies. And when I'm recruiting against very competitive alternative offers. And I like to think that we have great companies, great cultures, great science, strong syndicates, terrific boards, et cetera. And nonetheless, it's really difficult to recruit. And second, I think we're coming out of this 14-month pandemic at a time where people are kind of reevaluating life and thinking about, where is my career? How do I want it to be? What is it like coming back to being in the office with my colleagues? It's easier than ever to interview for a job. You can take a Zoom call from a recruiter without any of your colleagues knowing, because you're doing it from home. And that's whether you're a junior scientist or a C-suite exec. And so the talent war is as challenging as ever. What's great is that we've opened up, I think, the aperture to realize that great talent in many cases can work from anywhere and be really, really productive. But we're asking managers and leaders to create culture and cohesion with more distributed workforces than ever. So I think it's going to be something that we're going to continue to have to really lean in and think about and be creative about. And I have an intuitive bias that people do build culture, rapport, goodwill, and trust in each other faster and better when they get to spend time in person, even if they need to have flexibility to be able to manage their life, have reduced commutes, and have a bit more balance in their lives. And so I think it's going to be an ongoing battle. We have way more good science, way more good ideas, and way more money in the system than we have experienced leaders and talent. So this is the work ahead for us, whether it's Los Angeles or any other of our ecosystems.
Yeah, it's fascinating. And maybe I'll just make a comment from a dinner I had last night, where a friend of mine who's building a company has hired 100 people. It's a high scaling company right now, 100 people in the last year. And the expectation is that actually these folks will stay remote. Like, they have interviewed and been all over the country. And the baseline is that they will not need to be in person. And so that kind of changes the dynamic of the talent pool as well. So it's just an interesting sort of conundrum where, that you have to add into the talent wars is really the variable of location may not be as important anymore. But culture, and how do you build a culture in the absence of a physical, geographical home is much more challenging. So, I'd love to hear any additional comments on that. I find this a fascinating topic right now.
I can add onto it. So I think companies are really now much more flexible. So we have companies lab space in the LA areas with CEOs in another city, in Seattle, in New York, and it seems to work well. And I also think that for investors' perspective, part of the due diligence is to go and meet the team and visit the site. And I remember 2 years ago, I drove from San Diego to LA region just to meet the team, and ended up being stuck in traffic for like 3 or 4 hours leaving LA to San Diego. And I learned my lesson not to do that on the Friday afternoon. And I think that probably could be changed. Some of those activities could be done virtually, even though not everything can be replaced completely.
Excellent. I see we only have about 7 minutes left, and I do know there's a handful of questions. So I'm going to put a pin in my questions and go to the audience questions, because I do want to make sure that the audience gets what they want out of this as well. So one of the key questions we got was, what is the anticipated range of financing for pre-seed or seed opportunities from academia at the company formation stage? I know from my experience, this ranges. And so I think maybe I'll ask other groups to comment. And maybe to add on here, do you price rounds? Do you do convertible notes? Because I think that's also something that may be interesting to the audience. So free for all, anyone who wants to speak up, go for it.
I have a very strong point of view regarding not pricing these rounds. I think I agree with you, Deborah. Ranges, to me, it depends entirely on what that money is going to accomplish. But I think there's no greater disharmony than when you as a founder have to go back to your seed investors, who are often your friends and your family, and explain to them that the Series A investors are pricing it differently because they don't see enough value creation over those 6, 9, 12 months to give you a flat round or a step up. And it's much more peaceable in the kingdom if you do it as a convertible note and give those early risk investors a discount to your Series A instead of pricing your seed.
And just to add one quick comment, I think that valuation, for example, in Asia is totally different comparing with the US.
Yeah, I mean, I think, both of your comments are so relevant because
and speaking about biotech.
Yes.
Speaking about biotech, I may not say the same thing necessarily in tech or even digital health.
Yeah.
It is very much a market-driven event. And so I think it's a challenging thing to price before you have enough data to really, see what the end looks like. And so I think that's the best way we find to align very early with the academics and the entrepreneurs is to build together and then price the round at the Series A. And I guess just the range very much, just to put numbers, just because I know no one said numbers, I've seen in my experience everything from $100,000 to, $10 to $15 million in a seed stage round. So there's a wide range. I think above $10 or $15 million, then you do get to a point where it is more challenging to do a convertible note. And so that's sort of where we kind of draw the line from seed to Series A.
Yeah, I think it depends on the market condition and depends on the company, the technology platform and what it takes to get to the initial proof of concept. I mean, that's not even like preclinical, right? There's a certain set of experiments that have to pan out in order to then seriously consider further building the company. And so I don't think there's just one, there isn't like a roadmap. It really depends on the technology, the concept, and where it needs to go before a Series A. There are many different ways to get to that point. I mean, you can get friends and family, typical, angels. I know of other startup companies there are like family offices that do both philanthropic and venture investing. And they're straight out, venture groups seeding companies at a substantial amount that could be, 5, 8, 10 million, but that really depends on the company's platform and where they need to go and the bet that the investor and the entrepreneur is willing to make.
Excellent. Thanks, Helen.
I don't have a lot to add to that, but I would say I would agree with Nina's strong point of view. We would generally recommend a convertible note or a SAFE. We'll put in up to $1 million and less in a pre-seed, up to $1 million in a seed, and for some early biotech deals that's not sufficient, and we're quick to recognize that and then syndicate with other investors. And we've invested side by side with 8VC, Nexus Venture Partners, with Caltech itself, and hopefully with some of you in the future.
We're increasingly using safes where we have a cap to give, and this is us as investors in those seed rounds. We're using a cap, so we have some price protection against a really high Series A price, but we're using a discount to the A, and we do a lot of seed investing, a ton on the tech side. So it's absolutely standard there, but we've probably done in the last 18 months, 6 on the life sciences side. And these are both, outside sourced as well as internally sourced life science opportunities. And we just feel like it's the best alignment between the money and the science. It gives the opportunity for future price setting, but some protection for us who are taking their early roll up the sleeves. And we're often working very hand in glove with the entrepreneur. So we feel like we deserve and earn that cap. And it's in a nice alignment. We've done so many really difficult renegotiations when we've come in at the Series A and gone back with founders and the CEO to those early seed investors to re-architect and explain why that price wasn't right. It's just it's a very painful thing to do. It was very well-intentioned early money, but so completely out of sync with market.
I see Mark has come on to tell me we're out of time, I'm sure.
Yes.
Can we do a 15-second roundabout of
Absolutely,
words of
yes.
wisdom?
Yeah.
All right. Everyone, it would be great if you could just share your words of wisdom to the audience, 15 seconds max each. I'm going to go down the screen. Sean, you first.
Well, I think we've said it already. In other words, try and do your homework.
Different topic because you
Information on the websites of these entities, talk to people, and try and find the right profile of venture group to work with.
Helen, you're up.
So this has been passed on to me from my mentor at Penoid, who was one of the founders and CEO of Chiron. He always said, biotech is not for the faint of heart. It has many challenges, and look at the probability of success of molecules that start from discovery to approval. So it's a tough road, very rewarding, but you got to have that courage and perseverance.
Excellent. Nina.
Do science, love science, teach science, preach science, fund science, vote science. We're all proof that science can help us turn a corner even on the darkest times. So keep the faith and let's keep doing what we love.
Awesome. Yinghong.
So be have a clear vision and be really committed because it's not easy. and because there are a lot of academic founders maybe here, I want to emphasize that if you are considering taking a license from university or anywhere, continue to validate and develop your technology and also build a team and make sure that the early discovery can be translated into a drug. And I think that is so important, and make sure you have the IP due diligence.
And Kevin, bring us home.
Thank you, Deb. So I would just repeat and reinforce what I said earlier, just because it's so important from the perspective of a very early stage company. It's critical to be able to answer the question, who is going to run the company and who's going to be driving the technology and the science forward day one, particularly if there are academic founders involved.
Excellent. Thanks, everyone. Mark, I'm sorry for going a few minutes over.
Oh, no. It's a heavy
thanks to
heart.
everyone for the great panel. And we just needed a lot more time, but it was really super
You're
fun.
just starting it. So thanks.
Thank you, Mark.
Thanks, everyone.
Thanks,
Thank
everybody.
you, Mark. Thank you, Deborah.
Thank you.
Bye-bye.
Bye.
Bye.
Bye.